to actually go ahead and hedge against the rupee depreciation. Several options are available. I'm sure all of us are wondering what could those options look like, because this is a slightly tricky situation right now. And Alex has all the answers for all you viewers and investors as to how you can actually hedge against the rupee depreciation when it comes to making your investments. Alex, go for it.
Well, whether it is a trip abroad on a vacation where you're concerned about how much you're spending to buy those dollars that will fund the trip, or it is sending somebody abroad to study for foreign education, you need to watch the value of the rupee against the dollar. So is there a way to protect against the falling rupee? Let's talk about a few options. The first one that you can consider is gold, because India is a price taker. It's an importer of gold, and gold is denominated in dollars. So when you're buying gold, it is fungible, and so essentially, if you're buying an ETF, then the price of that ETF in rupees is adjusting for depreciation on an ongoing basis. If you look back the last 20 years, on an average, the rupee has depreciated about 3% or thereabouts, and the ETF is actually adjusted for that. Now, beyond this, you can also look at investing in a few mutual funds through either mutual fund schemes or ETFs that are India listed. The problem is that the SEBI has an overarching limit for the industry, $7 billion for the mutual fund schemes and a further sublimit of $1 billion for ETFs. And that has been hit, as a result of which these schemes are not issuing new units in the ETF space, and schemes are not investing more money in international assets unless they have the ability to do so when redemption comes through. And the result of that is that there's a huge gap between the traded price of ETFs in India and the net asset value of the fund. I looked at one example, and that's Nippon Hang Seng Bees, and it's trading at a 19% premium to the NAV. So when you're buying it, you're not really paying what you should be paying per unit for this ETF. It's a dangerous thing to do. So what should you consider doing? Well, Gift City is an option for you. There are a few mutual funds that have gone ahead and launched schemes that are outbound for retail investors. But even here, there is a minimum amount that you will have to cough up, and that's $5,000. It's not a small amount of money. And remember, if you put more than 10 lakh rupees in something like this through the LRS route or the liberalized remittance scheme route, you will have to have a tax collected at source of 20%, which you can adjust down the road when you claim your returns. So it's not the most easy route to consider for large sums of money. And finally, through the liberalized remittance scheme, you can also have a foreign account, a trading account that you can have through Indian brokers or through Indian brokers that have foreign partners. And that allows you to buy stocks or ETFs directly. Just bear in mind that the capital gains treatment is different from equity here in India, and it's a 24-month cycle for it to be considered long-term capital gains, after which it will be 12.5% of capital gains. So there are options available for you apart from holding dollar in physical form, which is not really a good idea.